Federal Bank's Q3 FY22 earnings report was a continuation of the strength exhibited in the past couple of quarters that convinces us that this is the ideal mid-cap bank to ride the recovery and no better time than now to add the stock at an undemanding valuation. It was in a way a landmark quarter for Federal Bank Q3 of FY22, which was aided by steady core performance and reduction in provision on improvement in asset quality. The bank was able to deliver quarterly annualized ROA in the excess of 1%. While trading gains were lower, core fees was supportive. There are more than one reasons, therefore, to like Federal Bank at this price. Asset quality, the Achilles heel for banking sector, appears to have been dealt with. A combination of modest slippage and higher upgrade and recovery resulted in lowering of NPAs. Provision cover stands at a steady 67%. Restructuring book inched up marginally from previous quarter and stood at 3,723 crores, 2.6% of the loan book, and the bank carries a provision of nearly 20% on the same, and almost 98% of the book is secured. Overall collection efficiency is at a healthy 96%, and if COVID does not become a disruptor, FY23 should see normalization of credit cost in 60 to 70 basis points advances band. The gradual return to normalcy is reflected in the loan book growing by 12% YOY, supported both by retail as well as corporate. The share of retail now stands at 54%. The bank is guiding to a much improved overall loan book growth in FY23 and beyond. While the decent ratio of risk-weighted assets to total assets at 56% points to good underlying asset quality, with the improved economic milieu, the bank is now ready to pick up higher-yielding assets like lending to commercial vehicles, microfinance, credit cards, so on and so forth. While the quarter saw a sequential 7 basis points improvement in its interest margins, the bank sees headroom for 5 to 6 basis points margin expansion on the back of higher lending yield and lower interest reversal on improvement in asset quality. Albeit the sequential decline in blended lending yield, the bank was able to improve margins as cost of deposits declined further. Federal Bank certainly has an enviable liability franchise with 94% of its deposits being retail and granularized. Deposits grew by 8.5% YOY, with low-cost CASA growing much faster, with the share now standing at an all-time high of 37%. This makes the deposit profile one of the best in class and equips it to chase better quality assets. Federal Bank's strategy of chasing high-yielding assets while maintaining its asset quality standards could well succeed thanks to its excellent liability. Improved macros coupled with the bank's readiness to position itself for the opportunity should result in stronger earnings and higher ROA in the quarters ahead. While high operating expense on account of manpower and spends on technology remains a dampener, the impact should wane as growth picks up. Federal Bank has been in the forefront of tech adoption and is leveraging partnership with fintech partners to add customers meaningfully at a competitive cost. Thanks to the capital raising of 916 crores, it has a comfortable capital position, a CAR of 14.4%, and is well equipped to win market share post the pandemic. The probable listing of its NBFC subsidiary could be an icing on the cake for a stock which is still at a very reasonable valuation. Of course, one risk to watch out for could be the severe impact of COVID on earnings and asset quality that you should keep your eyes out on.